we start the session? Yeah. Good evening, everyone. It's my great pleasure to welcome you all to today's webinar on source of income in New Zealand taxations. We are fortunate to have with us Dr. Saman Bandara, Senior Lecturer in Accounting and Tax with over 15 years experience in teaching and research. Dr. Saman holding PhD from University of Canterbury and Senior Chartered Accountants with both CA Sri Lanka and CPA Australia. With his combination of strong academic knowledge and hands-on professional experience, he brings a wealth of expertise to our discussion tonight. Welcome, Dr. Saman. Over to you.
Hi everyone, kia ora everyone, and welcome back to our second tax seminar. So if you can remember, our first session was held in February this year. That is mainly covering tax residency and some basics of New Zealand taxation. And also we discussed slightly on New Zealand tax framework. So they are the things we covered in the first session. If you missed out the first session, you can go through our YouTube channel. That's about Chartered Accountants of Sri Lanka, New Zealand chapter YouTube channel. That video is available. So you can have a look and update your knowledge on initial sections of New Zealand taxation. Today we are going to have kind of extended version of the same. And we know it's taken a little while to go bring you actually this follow-up seminar, this second seminar. So thank you for your patience, and thanks to CA Sri Lanka New Zealand chapter for organizing these kind of events to upgrade our members' knowledge. As promised, in this section, we are, that means in this seminar, so the second seminar, we are going to discuss basically two things. One is about New Zealand tax framework very briefly, and more time, like nearly 1.5 hours, I'll be allocating to discuss income. And also, I'm really happy to see participants here and welcome you all for this seminar. And I hope it will be kind of fruitful session for you to have kind of upgradation of New Zealand tax. Anyway, compared to the first seminar, we are moving one step further, and our focus, as I told you, to discuss about income, and I'll try to break down and clarify some important terms like gross income, net income, taxable income, assessable income, exempt income. See all words: income, different types of income, excluded income, sometime non-residence foreign source income. So already non-residence foreign source income we discussed in seminar 1 as well. But I'm not going to connect seminar 1 and 2, but I know we have done it earlier. Anyway, the idea here is to clear up what these mean in practice and how they fit into the tax system in New Zealand. So as you understand, I won't be able to cover all the detailed tax rules for every income source or transactions that we meet in our day-to-day lives. Instead, we will focus on the fundamental principles and some basic concepts that you can apply to determine revenue or income in any situation. So that's what I'm trying to do, rather than discussing individual rules behind the term income. The session may be, you understand, a bit theoretical sometime and occasionally quite dry. I understand it. You need to bear it with me because income is kind of theoretical lesson anyway. But I'll do my best to make it engaging and manageable. So let's see how things going with the time. Okay. Time. I need to move my cursor here and there to see how things happening in the chat box and all others. And I hope the session is recorded.
Yeah.
So I mean, is it recording?
Yeah.
Yes. Is that
yes.
Okay.
Yeah.
Right, no problem. And before we get started, just quick reminder about the disclaimer of the information. You know that this seminar is for learning and discussion purpose only, And I'm not giving any kind of tax advice or opinions for you to base your personal or business tax decisions on. And also, I won't be able to, or I won't be liable for any kind of outcomes or any kind of damages that might come from relying on what you cover today. Okay. And in addition to that, you understand that the information I'm sharing is correct to the best of my knowledge as at, I can say, end of August, more likely to last week of August 2025. Also, keep in mind, I'm sharing what I know, understand based on my experience and expertise in the field. If you do have any specific question, feel free to post them into the chat box here, in Zoom chat box. Even while I'm doing this seminar, if you get anything, so you can put into the chat, so then I can bring it when it is relevant to the content. And when I get time, so I'll answer for those questions. So that's easy than keeping everything to end to discuss. Okay. And I'll try to do my best to answer all the questions that you put into your Zoom chat box based on my knowledge and experience. In addition to that, before starting the seminar, just remind that we will share, I think your organizing committee will share this set of slides. And I have made them in a little bit detail for some areas, but I'm not going to discuss everything in all the slides today due to time limitations, because you understand we have nearly 2 hours. So within 2 hours, I'm trying to manage some content, but if you refer it later, you will see some more content and some examples, etc. So that will be helpful for you to use in the future. Okay. So that's the outset, and I hope everyone got kind of understanding about the background and the topic. Now we are moving for the content. As I told you earlier, already in our first seminar, we have discussed the introduction to New Zealand tax system and the New Zealand income tax framework, and also tax residency for individuals as well as companies. But I would like to recall the little bit of New Zealand tax framework again, especially to link the term income, because income is in tax calculation framework. So therefore, I need to show you the framework, and I need to go behind a few or two words mainly in income tax calculation framework to connect with the term income. That is my second section. Okay. In the framework, my intention is to talk only two words, tax losses and tax credits. Okay. I'll spend around roughly 15 to 20 minutes maximum on section 1 to talk about tax framework, because I have already spent 2 hours earlier, but I'm going to connect it with today's lesson. So then if you watch the video, there is kind of connectivity. And the second section, I'm planning to spend around 1 hour and maybe around 15 minutes maximum to discuss the term income. There I'm trying to cover what is income and assessable income, exempt, excluded. When do you derive your income? What is capital income, revenue income? So there are another two things. And what is a business? What is a hobby? And what is some other sources of income, like employment income, business income, income from property. So they are the things we are going to focus in this small seminar, like 2-hour seminar. Okay. I'm trying to give you kind of basic or overall idea about the thing, but later what you can do when you get the basics, you can understand it. You know, learning tax is like a tree. Okay, I'll take my pen. Just give me a second, quickly. Okay, here. You know, it's a tree. Tree, it's like this. Yes, sir, it's a tree. Why do I say it's like a tree? Tax is always like a tree. You have roots, trunk, and branches, leaves, many. Do you see? Many branches, leaves here. What's the connectivity? The roots basically represent fundamentals or basic concepts that provide stability and nourishment for your development of tax. That's this area. Mostly we learning tax law. I'm not talking tax law in this seminar. I take, but I'm not purely teaching tax law. I'm going to blend the law section and the practice. And the trunk is made up with core principles that support and shape entire structure, guiding how tax rules develop. Rules are here, do you see? rules are here. The basics are provided here. My main focus today is to touch this area. That means I'm trying to give you kind of core principles that will support to find or develop all the rules. You can find hundreds of thousands of rules in text. You cannot remember all, or you can't memorize everything. It's impossible. Even I can't remember sometimes. Even big practitioners, I'm not a very big practitioner, but still the high standard, high scale practitioners even can't remember all the rules. It's not possible. I can remember some rules because I'm teaching. So therefore, mostly the teachers can remember a lot of stuff than practitioners, the pure practitioners sometimes. Therefore, my main focus here, but I'll touch some rules, not all, some rules on this. When you learn the body or the kind of basic principles, you will be able to use because I know most of you are chartered accountants, you have kind of prior qualification in accounting and tax or whatever business area. So therefore, if you get the basics, you can apply it very easily. You can get the logic to apply anywhere. So then you don't want to learn rule by rule. You get the logic behind all the rules relating to income. I'm talking about income. So the job will be very easy. Okay, so then when you know the basics, you can quickly search and understand very fast. So therefore, my main focus here today, okay, to give you kind of core principles that support and shape the entire structure of tax rules. Okay, all right. Remember that one. I'm sure if I do this way, that will be easier for you to manage application of tax rules in the future. Okay. And in this first section, I'll look at the framework, as I told you earlier, tax calculation framework to link this lesson with the next part, that is income. See here, if you can remember this one, this was in first seminar as well. So you know how to calculate tax. So that's basic structure of calculating tax that can be applicable for any business. This is basic structure. We have gross income on the top, and from gross income, we'll talk about gross income today later. Right? This is our main part today. This and we will talk about deductions. I hope we will get the one day another session for deduction. I'm not going to talk about deductions. Only on one place I'll talk about some deductions, not many. But I'm sure we should have at least 2 sessions to cover deductions. That's huge, very wide section. And we get net income. Then from net income, we deduct tax losses. Then we get taxable income. For the taxable income, we apply tax rates. We get income tax liability and we deduct tax credits. Then we finally reach to terminal tax liability. That's basic structure of calculating tax. If it is individual, you have a set of rules to apply. If it is partnership, you need to apply a set of rules, but partnership will not be calculated tax from the business name. If it is a company, they have a set of rules, but still the basic structure remain unchanged. So that's the beauty of this. So therefore, learning tax is easy. If you understand each of these words separately, the job is done. If you can remember, I discussed a lot of details relating to tax losses and tax credits in my last seminar. We spent nearly around, as I remember, maybe around 10 to 15, maybe 10 minutes, 15 minutes to talk about tax losses. But I will recall you some basics again relating to tax losses before moving to my income discussion, because I need them some time to discuss the main one. This is the today's one, big one. Okay, today's one, not gross income, actually general income, but we are talking about the first line in tax calculation. So I will talk a little bit about calculating tax losses, or the term tax losses, just to clarify, because it's very interesting and important. In New Zealand, the carry forward tax, the most important thing, carry forward tax losses is mainly governed by, as like all the other sections, Income Tax Act 2007, you know that. There are specific rules around continuity of ownership and business continuity when you talk about tax losses. To get kind of highlights from tax losses, I'm not talking everything, but remember some highlights relating to tax losses. General rule is that you can carry forward tax losses indefinitely and you can offset against future taxable income as well as with other taxable income. But remember, losses cannot generally be transferred to another taxpayer, unless certain cases, I'll discuss them later, in group companies. In group companies, in some cases, you can transfer tax losses from one company to another. Other than that, generally, one person's tax losses cannot be transferred to another person. So that's kind of thing. So important thing you can remember, you can carry forward tax losses for any number of years for the future. So that's one thing you need to learn. And the second thing, there's no particular order, but anyway, another point, if it is a company, you need to consider another test called continuity of ownership test. What is that? Continuity of ownership test means a company can carry forward losses only if there is at least 49% continuity of ownership, generally measured by voting interest or maybe market value interest. Ownership is tested from time to time, or when we can say ownership is tested from the time the loss is incurred until the time is used. Okay, and the more importantly, from 2020, from 2020, there is another test introduced supporting to this 49% of shareholder continuity test. We call it SSBT, same or similar business test. That means if there is any company which fail 49% of shareholder continuity test, that means in 1 year, if you have some shareholders, at least 49% of shareholders should be same in the next year to carry forward your tax losses. That's the meaning of shareholder continuity test, very simply. If any company fail with this 49% shareholder continuity test, they can check the SSBT, that means same or similar business test. It means basically it says like they should, that means business processes or suppliers or customers or market position or maybe branding or assets use should be same over the period. That means if there is no major structural change in between these 2 years, still companies are allowed to carry forward tax losses from 1 year to another year. So that is second point. And the third point you need to remember, grouping, we call it grouping rule, or we call it loss offset between companies. In addition to that 49% shareholder continuity test of individual companies, if you need to set off tax losses in groups, let's say there are two companies, let's say company A and company B in one group. In generally, the nearly minimum of 66% of shareholders should be same to offset or set off one loss of a company with another company. So, and also there's another condition actually, the balance date, we call it actually year end, dates also should be same. For an example, let's say if a company A has 31st March year end, company B also should have the same year end, like 31st March. See, if you need to set off loss in one company with another, you should have 66% common, we call it 66% common ownership test. 66% common ownership test. Otherwise, that means at least 66% of shareholders should be same in both the companies, then only you can set off losses. The final point I want to mention here, see, I should have done 3 points. The fourth point you need to remember relating to tax losses, it's kind of learning point. There is something called ring fence, or we call it ring fencing rule, or sometimes we call it ring fenced losses. Ring fencing. What is ring fencing? I think we discussed earlier as well. You know, I told you earlier, if you get any tax loss from one source of income, you can set off against other sources of income. Let's say, simple example, if you have 3 sources of income, if you're a person, let's say you have employment income, you have a business, also you work as a contractor. Let's assume there are 3. You have employment income for one company, you have a business, and also you have a contractor income. That means if you get a loss from business, you can set off against contractor income. So that's fine. You can do that. Same person. But let's assume if you have a rental property. If you get a loss from rental property, you are not allowed to set off against these other profits. We call it ring fenced. Ring fence means, very simply, residential rental property losses are ring fenced. That means not allowed. to set off against other sources of income. That means residential rental property losses can be set off only against residential rental property losses. You are not allowed to set off against other income like salary, wages, or business income. So that's what we call ring fence rule. So that they are the kind of core concepts behind tax losses. Okay. If you have any question, you can put into the chat. So then I'll pick it. I can see your chat box here. So therefore, if you need, so you can put it there. The next thing is about tax credits. We discussed heavily about tax credits in first seminar as well, but I need some of tax credit just to recall something. You know what is tax credit? It's kind of, we can say, incentive, which allows certain taxpayers to subtract the amount of credit they have accrued from the total they own to IRD. So that's kind of incentive you can deduct from your taxable amount. Sorry, final terminal tax. Tax credits are basically classified into two as refundable tax credit and non-refundable tax credit. If you can remember, if you need to get more details, you can watch the video one or the seminar one, which is available in YouTube. We have discussed about foreign tax credits as non-refundable tax credits. Also, we discussed something called IETC, Independent Earners Tax Credit. So you can search what is Independent Earners Tax Credit we need. So, basically, if your income is in between 24,000 and 70,000, you get $10 per each week. We call it up to 520. That means 520. And when your income goes up, passing 66,001, 13% deduction. As a result of that, at the end of 70,000, you will get zero. So that's what we call IETC, but I'm not going to discuss in detail about it. That's kind of non-refundable tax credit. And the most important thing, donation tax credit. You all know that when you donate money to your kids' schools, or maybe sometime when you donate money for approved charitable organizations, including your temple or church, you can get 1/3 tax credits from IRD. Let's say if you donate $300, you can get $100 as kind of refund tax credit called donation tax credit. That's very easy job. You can log into your IRD account, go to I want to menu, and you can see to register for donation tax credit. Register there and submit your invoice, then they will give you money. So that's very simple. Okay. So they are kind of non-refundable tax credits. And also there are some refundable tax credits, of course, like payee tax. You know what is payee tax? When you earn salaries and wages. And also if you pay any provisional tax related to companies or withholding tax, they are kind of refundable tax. When you're going to deduct tax credits, you need to start from non-refundable credits first, but after that only you can claim refundable tax credits. And also, what about, I said about donation to charity tax credit, 33%. 33 means one third. Can companies get donation tax credits? What do you think? Can companies get donation tax credits? Anybody? Any idea? You can put in the text. Generally, companies do not get donation credits. Instead, what companies can do, they can claim deductions for donations made to approved charitable organizations. And also remember, the donation deduction is limited to company's net income for the year. If company has net income, let's say 100,000, they can't go beyond 100,000 to get any kind of donation credit. And also remember, if the company has no income, donation deduction cannot be used or you can't carry forward for the future. So there are kind of special cases relating to donations for companies, but if you get a chance to discuss company tax one day, so we can discuss more about it. Okay. There are some other slides to learn how to organize your tax credits when you have refundable and non-refundable. So this is just for your self-study purpose. I'm not going to spend more time because see, I told you I will spend roughly around 15 minutes. I have already spent 15 minutes. So on tax credit, my main focus is not that. My main focus is about section 2. So that's all about New Zealand tax framework. Hope you understood the way of calculating terminal tax liability. And now main focus is here. I'm going to talk about not gross income, general income. Gross income is one word. So what is gross income basically? See the first word on the top, you can see gross income. Sometimes you confuse with the term gross income, assessable income, net income, taxable income, exempt income, excluded income, non-residence, foreign source income. See how many income words. That's a lesson. We need to understand what are these different types of income. That's one thing. And also we need to understand if you earn something, is it an income? Let's say simple example. Sometimes there are people, even in university people, students do that mostly. Where if you see something in the marketplace, you see any kind of item, let's say mobile phone or bike or whatever, or computer, whatever used item in marketplace, when they post it as free, what you do, you go and pick them. You do certain modifications and sell them. Is that income? Do you need to pay tax on it? Let's say simple example, you time you do that. What you do, you buy or not buy, actually you pick free items on the marketplace and sell it. People do that, I know, some students do that. Is it an income? Do you need to pay tax? If it is income, of course you need to pay tax. And sometimes what some people do, mostly males, what they do, they buy a car and hold it for some time and sell it, time. They do a couple of buying and selling transactions like that. Is it an income? Sometimes what they do, they keep that cash on hand. They don't deposit any money into the bank account. They roll it over. So is it an income? Do you need to pay tax on it? So they are the things we are going to discuss actually. Basically what is gross income is that the total income of a person derives before considering any exemptions, exclusions or deductions. That is gross income. What you get, that is very simply gross income. What are the things you get on your hand before any deductions, exclusions or exemptions? Then sometime it's very clear. Net income means, the word is very clear, after making deductions or expenses, you can say in normal terms. And sometimes what is assessable income? Assessable income is the portion of gross income that is subject to tax. Assessable income is kind of portion of gross income. Out of gross income, you charge something for the tax. That is what we call assessable income. It excludes exempt income, and I'll discuss those words later anyway. Excluded income, those kind of income, and also sometimes non-residence foreign source income, excluded. In short, what I can say, gross income is everything you receive. Assessable income is the taxable portion of gross income. You need to clarify those two words to go forward. Otherwise, time I will use those two words, gross income and assessable income, in my next couple of slides. Understood? Okay, any questions so far? Now we are starting the section 2. I'll talk about other words later, exempt, excluded, non-resident foreign source. I'll discuss those words later. Okay. Any question? No. Okay. Good set of people. They don't have any question, which is good. Set. Right. I'll engage with participants time to time, post in some polls. Question. It's not kind of question, but just to make you live. Or sometime I need to wake up if you are sleeping somewhere. So therefore, I'll post some polls time to time to get some kind of feedback, or just read it and click on some answers. So that's it. Not to test your knowledge, but just to keep you live. Right, in section 2, this is our main section. I spent nearly around 22, maybe nearly 15 to 20 minutes so far. In section 2, that means this is our main section. We are going to discuss several things and other things. I have a severe sore throat today, so therefore I need to have warm water time. Sorry about that. Then next one is, what is income and assessable income? We are going to start from that point. I'll talk about exempt income, excluded income. When do you earn income? That is what we call derivation of income. And we will talk about what is capital income, revenue income, and what is a business, which is not a business, what is a hobby. So we need to understand it. So in my previous 2 examples, I said, if you are doing something, pick from the marketplace, free stuff and sell it, is it a hobby If it's a hobby, you don't want to pay tax, of course. If you sell a motor vehicle occasionally in a year, is it a hobby? If it is a hobby, you don't want to pay tax, of course. Hobbies are not taxed. If you're going fishing time to time, you catch some fish and you sell to your neighbors. People do that. You can do that. It's not illegal. We have some limits to catch fish. That's a different story. But whatever you catch, you can get home and you can, some people do that. Just to cover the fishing cost. You can do that. Is it a hobby or is it a business? Kind of discussion we need to have. Okay. In motor vehicle example, anyway, how this thing can happen. I think I explained about it in first seminar as well, but anyway, we'll discuss it later. And also we will discuss some few sources of income. We don't have time to discuss all the sources of income, but based on the practical significance, I'm thinking to discuss about employment income. There I'll talk about employee versus contractor discussion as well, which is not directly plugged with income, but I'm planning to discuss. And we will talk about income from properties as well. There are two types of properties: personal properties and residential and commercial properties. So then we will talk about them separately at the end if you get enough time. That depends whether we get a reasonable amount of time to discuss. Okay. It seems like we will be able to complete everything because no questions. So that's easy. Right, we'll move forward in section 2 now. Right, what is income? These are not my words. These are words as it is from Income Tax Act 2007. Generally, Income Tax Act, there are different sections. Income, I forgot to tell you at the very beginning actually. Income is covered in section C. Most of the sections you can see from C, letter C. That means most of the guidelines relating to income is provided in section C of Income Tax Act. Also, if you can remember, we discussed about Income Tax Act, Tax Administration Act, how IR is empowered, everything we discussed in seminar 1, if you can remember. Section D is mainly relating to deductions or expenses. So therefore, if you refer any rules relating to deductions, you can see all the rules referred with section D of Income Tax Act. Anyway, CA1 here, what it says: an amount is income of a person if it is their income under provisions in this act. It's not that much clear. See, amount is an income of a person if it is their income. It's not much clear, is it? Actually, Income Tax Act doesn't want to define income very narrowly. If so, what happens? People will avoid it very easily. So therefore, what they do? They keep it very broadly. At any point of time, they can catch you into the income network. That's why they keep it very broadly. Nobody will define these kind of broad terms narrowly, because then people will avoid it definitely. So that's the reason, of course. And also it says in point 2, it says an amount is also income of a person if it is their income. Again, income of a person if it is their income under, another word is there which is important. We call it ordinary concept. And also there's a definition in BD1 relating to income. Means again same thing. See, person means income of a person in section BD1. Then it says some other definitions. But I need to go after this important word called ordinary concept. So what is ordinary concept? See here again, part C, part CA1. It says again, an amount is also income of a person if it is their income under ordinary concept. Then we need to understand what is ordinary concept. So there is no specific definition for ordinary concept in ITA. We call it Income Tax Act. So then what will happen? How do you find out what is income? Then our topic is understanding income, but there is no definition. Actually, it's okay, no problem. Most of the time, for those kind of broad things, nobody can define it clearly what it is. That's why we have some other indirect, not indirect, actually, kind of other ways to understand this term. One of the important ways to refer case laws. and some clarifications or guidelines issued by IRD time to time. See, many of the items included as income in this act or in practice are obviously be regarded as income because they are in ordinary sense we can understand their income. For an example, if I say business income, of course you can say, yeah, it's income if I do something as business. Interest, of course you will say, if you get some interest, of course that's an income. Dividend, if you get some dividend, you will say, okay, that's fine. If you do some kind of employment income, servicing, they are straightforward. Obviously you can say they are income. There are some other items less obvious income. For an example, let's say in my previous two examples, if I say, if you sell your personal car, is it income for you? If you sell your personal car 5-6 times in a year, you can do that. There are no restrictions. Is it income? Or sometime, let's say you have a business, you are going to sell the business, selling the business. Then you created some good name of the business over the past couple of years when you work. When you sell, you charge some money for goodwill. You have assets in your business. In addition to your assets, you are going to charge some amount of money from your purchaser or the buyer for goodwill. Is it an income to you? Sometime, these are examples, okay? Not clear. Sometime, let's say another example like sale of land. If you're going to sell a land, if you sell your personal laptop, for a profit, is it an income? You need to think then. I'm not going to ask answers always since it is a webinar. I don't get time to discuss always because we have only 2 hours. But if you are actively listening to this, you need to think, oh, is it really? If I sell my personal laptop, is it an income? Do I need to pay tax on it? Let's say I bought it for 3,000, but I'm going to sell it for 3,500 after a couple of years use. Let's say I bought a couple of monitors to run my online teaching business. Then I earn some money, I claim depreciation, now I'm going to sell it. It's my personal laptop. Is it income? So they are kind of less obvious cases. There are many scenarios we can take, not very clear whether they are income or not. So therefore, based on case laws, there are some basic principles. Can you remember my tree? I told you these principles are attached to the trunk or the roots of the tree. Can you remember the tree I told you at the very beginning? So therefore, there are some basic core concepts, or we call it useful indications or principles, or sometimes we can say fundamentals, that we use to clarify this word income. One is intention. That means the income will depend on your intention. Then someone can ask, how can I see, how IRD people can see my intention? Of course, we can see easily. There are many physical evidence to see a person's intention. So, intention, sometimes we feel intention is inside. No, it is not, of course. Intention is not inside your head or in your heart or somewhere in your body. No, it's not. It's very clear, visible. I'll tell you how to find it. Okay, I'm talking in taxation, in income. Generally, now I'm going to discuss about this important indication. One is intention, and I'll discuss several others later. I have given one case here that is about what is the case? Californian Copper Syndicate versus Harris. So that's kind of very old case, right? Court case in 1904. See, very old. What's the issue? The issue was whether the profit made on purchase and resale of mining property was gross income or not. Issue was to see whether a profit made on purchase and resale of a mining property is considered as gross income or not. See, mining property. What happens actually originally in this case, a company acquired copper-rich land intending to profit from its sale. That means, of course, original intention is to resell, not to mine it. When you buy a land, of course, like copper land, you can understand it's like capital asset purchase, of course, yes. But still, not to mine it, they bought with the intention of reselling. When the land was sold for shares, that means they block the land. That's the story here. They block out the land and they sold it for different people. Then court, then there's a issue. Then court decided it is not a kind of capital flow, but it is kind of income, because the transaction was to earn some profits within these activities. And also, it is very clear what is a decisive factor here. Factor was taxpayers' clear and evident purpose and intention. What's the purpose and intention? Purpose and intention is to make profit. So therefore, even though it is like capital receipt, but it is an income, gross income. That's a good point. Very good question. Yes, I know this, sir. Can the intention, I'll take questions when it is related to the discussion, sorry, be changed subsequently? If yes, then tax implication would also be changed based on that. Actually, answer is no. We always test this intention. Actually, if you deeply study this, I think I discuss it later, called dominant purpose. Dominant purpose, I'll discuss that one with kind of example of buying and selling shares later relating to the same question. You need to test it at the time of buying. At the time of, that means at the time of transaction is done. Later you can change, of course, yes. It is irrelevant. What was the original motive? That's what we need to check. Not subsequent changes. Subsequent changes are ignored. So that's, I hope you got the answer. I'll show you one example later of buying and selling shares. When you buy shares, of course, you have you might have two intentions. One, to gain capital, to earn capital gain, and the other one is what is called dividend. Then how can I see what is your intention? Is it to get capital? You can say now, initially my objective is to get capital gain, but later I change my motive. No, there are certain cases I will show you later. But yeah, at the time of transaction, we need to test it. That's a very good point. Right, I discussed about nearly 40 minutes. So therefore, I like to go for a small poll. I set up it. I don't know whether it will work properly. Let's check first. I'm going to put a poll just to ask a small question. You can see it on the screen as well, but I'll try for a poll. What is this? Is it income? Let's check what is the question first. That. No, Alex told it. Yes. Yeah, I'll launch a poll. Just select your answer just to make you active. Launch poll. That's launched. Don't worry about hobby. Just answer. Is it a business? You can read the story here. Now I can count out of 60 how many people active. I'll tell you the rule we need before answering. Just 1 second. You know, in New Zealand, according to Ministry of Business, Innovation and Employment, they have defined what is motor vehicle trading company. So who are the people need to register under motor vehicle trading? Okay. Accordingly, what it says, because I see everybody's telling business here. Therefore, just wait for a second. I'll explain one thing. I don't know whether you can remember this. Generally, what MBIE, that means Ministry of Business, Innovation and Employment, what they say, they consider a business as kind of a company or business who is doing motor vehicle trading if you import more than 3 motor vehicles within 12 months period. If you import more than 3 vehicles, within a 12 months period, you must register as motor vehicle trader. Or the second one, if you swap, sell or gift So sell or gift more than 6 motor vehicles within 12 consecutive months, more than 6 motor vehicles within 12 months period. That means if you swap or sell more than 6 motor vehicles within 12 months period, you should register or you will be counted as motor vehicle trader according to Ministry of Business and Innovation and Employment. Okay. And the third point, if you advertise to sell at least one car, if you advertise, in this case, you don't advertise. Okay. If you hold out, advertise, state, notify, or represent that you are carrying on a business of motor vehicle trading, it doesn't matter how many vehicles you actually trade. If you, very simply, if you make kind of public advertisement, it doesn't matter whether 3 or 4 or 5 or 6. You should register as, or you will be considered as motor vehicle trader. Based on that, now you need to understand, answer for this. What do you think? Quickly, I'll give you 2 seconds. Done? Everyone? Time, I can find how many people actually active. Good thing organizing committee, you can find out who are the people actually deserve for what is it called, CPD, is it? Just kidding. It's not something like that, but anyway. Okay, that's it. Enough. I'll end the poll. I see here, I don't want to share this results, it takes time. Okay, I'll read the results. 41 people responded for this. We have anyway 60, 19 people missing. And that's of course natural in any seminar. 41 people, sorry, out of 41, 33 said it's a business and 8 said it's a hobby. What's it actually? See, Alex, according to the previous point we discussed, according to this point, it's very clear when he makes profit. Actually, when I discuss the point and put this poll, it's very clear, right? What is it? You can say it is a business. That means the person should pay money. Even look now, I said, generally what MBIA says, if you sell less than 6 motor vehicle, you're fine. But still, you have done it consecutive 2 years, 5 each, and you have earned a profit in each of these cars. It's very clear, even though it is not counted under MBIE definition, it is very clear here. Intention is to get some gains. So therefore, that will be an income. So that's what I want to discuss relating to this small story. Okay. Right. I hope poll was, did I close poll properly? Still appearing on your screen? I think all good. Okay, that's done. Right. Next one. I'll move forward now. Another important aspect you need to think is, when you talk about income, income is what comes in, but not what is saved. It's another kind of logic you need to think. If you can't identify income clearly, you need to think from these aspects. What is the intention? Is it something help to save your expenditure? If so, it is not an income. Always income is something comes in, not a savings of outgoing. So it's another important point you need to think. When you define income, that's another point. See, it says the taxpayer, there's a case here, a taxpayer enrolled at a primary teacher's training college. While studying in the college, that person received financial assistance in the form of student teacher allowance. Student teacher allowance. Okay, so it's kind of story. This is the Reed case, Reed versus CAR case. In this, actually, what happens originally, High Court decided that it is an income. But later, Supreme Supreme Court, Court of Appeal found that no, it is not an income under ordinary concept, because income is something that comes in, not savings from outgoing. Actually, the bursary or kind of financial assistance provided for a teacher in a training college is mainly to cover that person's expenses. So therefore, it will not be an income. So that's the definition. So therefore, if a benefit serves a person from incurring expenditure, the saving is not an income. That's a fundamental principle behind this. I think we can understand easily. The principle has also been interpreted as meaning that income is something that is money or money worth, cash or cash worth. If a benefit is not convertible into money, it's another thing behind this story. If there's any benefit you get, but you can't convert into money, of course, it is not an income. It's another principle according to this Reed case. See, I told you under this two things. If you save any expenditure, it's not an income. If you can't convert something into money, I can tell many examples, not convertibility of money. Let's say, for an example, your employer, let's say you are selected as the best employee of the month. You were selected as best employee for the month, and you are given an air ticket to fly to, let's say, USA. You are given an air ticket to fly and enjoy your holidays in USA. But other expenses you have to bear. You are not allowed to convert that air ticket into cash. Of course, that air ticket, if you get the air ticket and fly to enjoy your holidays, it is not an income. Why? You can't convert it into cash. You can enjoy the benefit. So it's another important point you need to remember. Also, what I said earlier, yeah, that is about the second point. Yeah, money worth. Yes, right? Money worth and the convertibility. And also, when you talk about this convertibility thing, it is very important consideration in determining tax treatment of price received. See, now when you get a prize, see, prize means if you get a gift or like prizes, like earlier I said, good example, a prize will generally be included in a person's assessable income if it is convertible only. Otherwise, that will not be counted as part of assessable income, right? Also, remember what will happen relating to another kind of gifts like windfall gains. You know, windfall gains. Basically, windfall gains would include like gifts and receipts from an inheritance, as well as winning from games of chance, like lottery winning, gambling sort of things, casino, those kind of things. If you get any windfall gain, do you need to pay tax on it? No, again, right? Okay, there's a question as well. If a person continues to sell only 5 like this every year, he won't get tax. No, I didn't say so. I said he has to. Reason, intention. According to definition, yes, but intention is another principle based on law. So therefore, he has to pay tax. Another question, let's see. If employee receive a gift, air ticket to USA, isn't coming under the... that's different story. Very good point. We will talk about it in coming slides. If anything is counted under, I didn't say so earlier, right? If any non-cash benefit, that's what we call actually FBT, fringe benefit. You can see the question in the chat. If any non-cash benefit provided by employer to employee, okay, then FBT will be paid by employer. In that case, anyway, it is not an income to employee. My answer is same. Yeah, one reason is if it is counted to FBT, there are some benefits. I'll talk about them later. There are some benefits which are not counted into FBT. If any benefit, non-cash benefit, I'm talking about, not cash benefits. If any non-cash benefit provided by employer to employee, which is not counted under FBT, sometime might be an income to employee. That's why we are going to discuss these basics. In that case, you need to think, okay, good example, let's say if your employer providing some very good example, overtime meals. Let's say when you work for overtime, sometimes your employer can give kind of meals, or sometimes your meal expenses will be reimbursed. In that case, it is not going to FBT, will be an income. Still, if it is saving of expense, you can exclude as kind of income for the person or the recipient. That's the idea behind this. That's a very good point. I'll discuss further about this in next couple of slides. Okay. Right. Another important principle. See how many principles here? Earlier I said about intention, convertibility of thing into money or money worth, and saving of expenditure. All these are kind of considerations when you need to consider when you decide your income. Another three things: periodicity, recurrence, or regularity. Means how often that happens. Very simply. Generally, these three factors again important in determining whether particular receipts bear features or characteristics of income. However, it has been accepted that the assessable profit need not necessarily be recurrent within a year of assessment. Good example, earlier we discussed about 5-car story. Not essential. It is not essential to be recurrent always. Even if you can remember the mining story we discussed earlier, one-off transaction, but still recognized as income. Therefore, this recurrence, periodicity, regularity is kind of fact you can consider. Always, if you get it, if that means it means recurrence is always there, more likely that will go into what is called income. It doesn't say, less recurrence doesn't say that it is not an income. That's how you need to define this point. Periodicity is, if it is very high, more likely that will be an income, but it doesn't mean that if the periodicity or the recurrence is very low, it doesn't mean that it is not an income. So that's how you need to understand this point. You need to be very careful. Okay. Right. The last point, one before the last, we call it quality in the hands of recipient. That's the theoretical explanation for this. That means quality in the hands of recipient. Income should be defined considering the quality. Then I'll explain what is quality in the hands of recipients. This means that this means determining the nature of the receipt from a recipient, nature of the receipt from recipient's point of view. That means we need to determine the nature of the receipt from the recipient's point of view, not from the payer's point of view. Basically, there is a very famous case where a gift is given to a solicitor from a client may not be income if that gift is made for personal reasons. It's a very famous story. Let's say, simple example, if you are working as a solicitor or a lawyer professional person, if you get any kind of gift from a client, mainly because of your personal qualities, not because of your professional qualities, that will not be converted as or considered as income. If that gift or the whatever the things you get is mainly because of your professional capacity or professional qualities, that will be an income. We can take many examples for this. Let's say for an example, tips you get as waiters. Let's say if you work as a waiter in a restaurant, you get tips. Income or not for the recipient. That means quality should be decided and defined from the recipient's point of view. If you are a waiter and if you get tips, is it an income for the waiter? Of course, yes, because it is the capacity of the waiter. Uber drivers get tips. Uber drivers or any delivery people, they get tips through their apps. Income? Of course. Why? That is within the capacity. Let's say example like this. This is like awkward example, but this kind of hypothetical one I made. Let's say like this, okay? Let's assume you are working for a supermarket. You are working for a supermarket as, let's say, night filling person, or let's say cashier or something like that, or help or something like that in a restaurant, in a supermarket. one day you notice that time to time when customers struggling to push their trolleys to their cars, you help them. It is not your main job, but if you are free, you can go and help them to push their trolleys to the car to unload their stuff. If you get a tip there, if you get any incentive there, is it income to you, income to the recipient or the person who works there? More likely no. Why? It is outside the scope of the person. So that's why we call quality in the hands of recipient. You need to be very, very careful with that. This may be subjective, but generally you need to be very careful when you talk about these kind of examples, because it's hard to decide whether it is within the scope of the person or without outside the scope of the person's work. It is within the scope of the person's work that will become an income, otherwise not. That's the turning point you can remember at this stage. Make sense, everybody? Right. Now, the next one. A little bit behind, but I'll try to catch it going a little bit faster in the future, in the next couple of slides. Another important thing is distinction between income and capital. I know okay, there's kind of small question. I'll pick that one quickly. If a person performs occasionally work for a company or individual, such as repairing motor vehicles or fixing computers on casual basis, do the payments received for these services fall under the definition of? Excellent, good example. You do it. Okay, I'll answer for this. I have an interesting story here, which is very similar to this. For a person who is going for deer hunting, with that I will answer for this. Okay, leave it for some time. There is another story here in my slides. I will show that one, and after that we will discuss about it. Okay, that's interesting, which is very similar to this. I'll continue with this section now. The distinction between income and capital. That means, most of the people here, accountants, and they know what is capital income, what is revenue income, what is capital expenditure, what is revenue expenditure. I don't want to explain them because I know you have kind of background. But anyway, generally, you understand, if you consider something as capital receipt, it is not an income. We will talk about capital gain and all other stuff later. But generally, if a receipt is of capital nature, such as an amount received from a sale of substantial asset, is not an income, whereas amount received on a regular or organized basis, we call it revenue receipts, are considered as an income. So that's the main theoretical point behind this. But still, there is no clear-cut definition to say what is capital receipts or what is revenue receipts. Sometimes we call it, in tax, we call it revenue account and capital account. Revenue account, capital account means in tax, revenue receipts and capital receipts. If it is a revenue receipts, of course, that is an income, otherwise not, very simply. So therefore, what we need to do is, since it is not clearly defined, again, we need to go after some basic principles or guidelines provided by court cases. See, I have taken a couple of court cases just to give you some fundamentals or basics relating to capital and income receipts, rather than just defining what is capital, what is revenue. Generally, I told you capital receipt can be defined as an item of wealth or an asset capable of producing wealth. Capital is kind of thing, is kind of wealth that you, or asset that you can create wealth. That's why we say now land, building, plant, machinery, they are kind of wealth creators. You can generate rent, interest, royalties, dividends, and sales. They are the income. That means what is called output. See, in this first case here, in this one, what it says, it's very interesting, a very famous case in tax law. This case introduced a very important the word called flow concept. Flow concept. What is flow concept? Basically, that case says capital is equal to the tree on the land, and income is a fruit or crop. That means the output, very simply. If you have shares, that is capital flow. If you get dividends, that is revenue flow, something like that. If you have a rented property, capital flow, the output or the outcome of renting, that means rents or royalty sometime, that will be income. In this flow concept, it says very clearly the receipt or the outcome is kind of natural produce of capital assets. If so, it will be an income, otherwise not. So that's the idea behind this. See, always income is equal to flow or yield from capital. That is a yield or the output of the capital. Okay, so therefore, I hope you understood the concept there. Sometimes capital is equal the asset or the principal itself. We can say example 3. If the gain comes from selling or increase in the value of the asset, that is capital gain again, not an income. Otherwise, revenue, that means income. For an example, let's say if the value of the land increases, if the value of the land goes up, again it is capital, not income. Understand? Not revenue. So anyway, this differentiation is or the distinction is very important because income is taxable, whereas capital gains in New Zealand, more likely, capital gains are not taxable. So therefore, always we need to understand what is it. But there are certain scenarios where we need to discuss separately under bright line test for properties. That's different discussion. We will do a little bit of that later. But hope you understood what is capital and revenue distinction. And another interesting story here. In the first case, that is CIR was City Motor Service, what happens? There was a petrol station or gas station. The gas station or the petrol supplier, the petrol station received a kind of payment from its parent company, or not parent, petrol supplier, or the person who is providing petrol to sell in the shed, to upgrade the petrol station premises. Very simply, a payment is received to a petrol station, or the petrol seller, from the petrol supplier to upgrade the premises of the petrol retailers. Then there's a problem, there's a concern in the court whether this receipt is income to the petrol supplier or capital receipt. Again, it is very clear, this receipt is to develop the infrastructure facilities, like developing the tree, developing the capital. So therefore, it is not considered as income, that is capital receipt. In the second case, in this case, what is it? VT or CIR was, I don't know how to pronounce that. In this case, again, examine this the issue. What happens here? There was a lump sum payment of a lease inducement payment made by a building owner to introduce potential lessee to enter to the lease. And it was held being non-taxable sum in the hands of lessee because again, it's like one-off capital nature payment or the receipts. So therefore, court decided that no, it is not taxable, it is kind of capital receipt. See, in both the cases, we provide some kind of understanding to think, okay, oh, what it look like, what income is appearing to us. Okay, so that's how you need to understand here. Okay, we will go for, I have this question, analogous question, I'll hold it for some time. I'll come into that point later. I'll go for another small poll. You can answer quickly without using much time. Okay, look at this. Where is that? Wait. Can you decide whether it is income or capital? There are two stories. There are two cases. They are very small, only one selection. You need to select whether it is capital or revenue. Meanwhile, I'll get some water. I see people answering, which is good. I don't have much time. So that's interesting. While you are answering, I'll tell you the answers as well. So that's good. Now, a lot of people are engaging. That's good. I see a lot of people responded for the question one. Except one. Everybody said capital receipt for the first time. So therefore, I don't have any argument. Sale of a subsidiary of shares, that of course considered as kind of capital in nature. Because it's long-term sort of investment and not part of regular trading activities. It is not part of regular trading activities. So therefore, first one, of course, clear. It is capital receipt. But in the second one, I see answers are scattered over your answers are scattered over 4 answers that I have given. Nearly 50% people said both revenue, 5% said both are capital, 20% said the second answer, and 24%, nearly 25%, selected the first answer. See, it is scattered. Okay, it's kind of a tricky thing anyway, you can understand. There are 2 types of insurance here in the second story. One is trading stock compensation. Yeah, of course, that's kind of, sometimes people think of trading stock compensation. You have stock, you lost stock, you are going to cover it from insurance. Loss of profits, anyway, I'm sure you will be very clear. Loss of profits compensation is income. Because profit loss you are covering, that means it's an income, of course. Trading stock, the ultimate objective of trading stock also to convert into cash and sell. So therefore, if you cover it through insurance, it's also an income. So therefore, correct answer should be actually both are income. So nearly 50% people said both are income, but other people selected here and there. But yes, it is kind of subjective, but correct answer should be that one. See, I extracted from Khan's study pack. Right, I'll end the poll for now. Thank you very much for your responses here. So now its responses have been increased drastically compared to the previous, which is good. That means people are actively engaging into this, which is good. Good to see so. Right, I end the poll. Sorry about that. I'm not sharing results because it takes another set of a few minutes to share it. Right, we'll go forward. Still, that question is there. I'll park it for some time. Right, now you know. Ordinarily, you can understand, okay, you need to think what is capital revenue when you talk about income. You need to think about the periodicity or the recurrence of happening it when you think about income. And also you need to think about the convertibility when you consider income. You need to consider whether it is saving of outgoing when you consider an income. On the top of all these, you need to consider intention when you decide an income. See, I told you 5 to 6 fundamental things, fundamental aspects that you need to look at when you define income. So I already told you what is gross income, and now we are moving to the next section of income. So there are a couple of other words, income words, different income words, relating to the main word income. Now, already we talked about gross income. So that I told you gross income is the total income of a person derives or earned before considering any exemptions. Assessable income is a portion of gross income that is subject to tax. Okay, so that's how I explained you earlier. So very simply, I can say gross income is everything you receive. Assessable income is taxable portion of gross income, which is very simple, clear. But there are some other words related to the same: exempt, excluded, non-resident foreign source. If you can remember, we discussed about non-residents, resident, non-residents in what is called seminar 1. I told you if you are a tax resident of New Zealand, you need to pay tax on worldwide income. That means New Zealand source as well as outside. If you are a non-tax resident of New Zealand, you need to pay tax only on New Zealand source income. So therefore, of course, you can understand there's any foreign income. That means income sourced from outside New Zealand for a non-resident person will not be considered as tax. So that's kind of simple thing. But my main focus here is to talk about these two words. I have already discussed this one, right? What is exempt income? What is excluded income? Mostly people confuse on this. Identifying this is very, very important, because if there is any excluded income, you exclude income, but you can deduct expenses. That's kind of very on worldwide, what is called seminar 1. I told you, if you are a tax resident of New Zealand, you need to pay tax on worldwide income. That means New Zealand source as well as outside. If you are a non-tax resident of New Zealand, you need to pay tax only on New Zealand source income. So therefore, of course, you can understand there's any foreign income, that means income sourced from outside New Zealand for a non-resident person will not be considered as tax. So that's kind of simple thing. But my main focus here is to talk about these two words. I have already discussed this one, right? What is exempt income? What is excluded income? Mostly people confuse on this. Identifying this is very, very important, because if there is any excluded income, you exclude income, but you can deduct expenses. That's kind of very tricky rule, right? So when you match income, so generally, in deductions, we can discuss one day if you get another session. When you take taxable income, you can deduct related expenditures. We call it nexus principle in deductions, not in income. Deduction, section D. It means expenses can be deducted to the extent you generate assessable income or conducting business activities. We call it limb 1, limb 2 in section D. That's a different story. But there should be kind of connection. It's like matching concept in accounting. When you take income, you can take only related expenditures to this side. That's kind of matching concept. You know that one. Same concept is here, but we call it nexus principle in taxation. But the interesting thing, if you get excluded income is not inside income, but still you can take deductions here. But if there is any exempt income is also not in this one. Exempt. You don't want to pay tax. Therefore, you are not allowed to take any deductions. It's a very interesting point, but we will discuss one day if you get a time to discuss deductions. But therefore, we need to discuss what is exempt income and what is excluded income. That's a story now. What is exempt income? There are some types of income that are explicitly exempt from tax by ITA. ITA means Income Tax Act. This means they are part of gross income but not taxed. That means they are part of gross income but not taxed. There are many examples like government, maybe social welfare benefits, scholarships, certain compensation payment, jury witness. I will show you in next slide. There are many examples. We can't remember all the examples. Even I can't remember all these. Nobody can remember all the big list. There are many. We cannot remember everything, but based on the practical significance, we can remember some important stuff. Remember, most important one, when a person derives both exempt income and assessable income, the person's taxable income will be calculated only with reference to assessable income. That means we are not, exempt means exempt. We don't want to pay tax, very simply. What are those items? Look, there are many items. You cannot remember everything anyway. See, nobody can remember all these lists. Just have a look at it. But if you can remember, that's okay. Otherwise, I don't know whether you can remember all these. Even I can't remember all these. I'll take some of them randomly, time here and there from different categories. See, example, salary paid under diplomatic or international agreements. For an example, if you are working for UN and in New Zealand receives tax-free wages under Diplomatic Privilege Act. So it's kind of act in New Zealand. Sometimes payments covering actual work-related expenses are exempt. Work-related expenses, if it is reimbursed, let's say for an example, if you're an employee reimbursed for fuel cost while traveling for work purposes, that will be exempted. Sometime if you're attending for jury services, jury trials in the court, So then you get some amount daily based on number of days you spend. As I remember, $31 or something for a half a day, and if it is a full day, something. That money is exempted. Payments made for child support or spousal maintenance are exempted generally. And also scholarships and bursaries are exempted. Sometimes compensations or sickness accident paid, money paid by ACC, so they are exempted. Income from societies, clubs, that is exempted for them. Very important, if you can remember what is called transitional residency. Can you remember we learned about transitional residency earlier? Yeah. Transitional residency we discussed in seminar 1. So if you can remember. So then if you have any transitional residency income, we discuss about it. What is transitional residency? If you move into New Zealand and within first 4 years of your tax residency here, you don't want to pay tax on your foreign sources of income mostly, but two things are not exempted. If you have any foreign employment income or if you have any foreign service income, they are not exempted. Other than that, within first 4 years of tax residency in New Zealand, you don't want to pay tax for your home country income, very simply. So that's what we call it's exempted. Gambling income, see, it's exempted. Some others like interesting thing here, you can see KiwiSaver government contributions. Is there anything specific related to KiwiSaver government contributions? Anything specific recently about KiwiSaver contributions? If you keep your eyes open to the what is called business environment, or maybe for the last budget, did you see anything new? You know that one, I guess. KiwiSaver government contribution, there are some changes. Right? I took that slide. If you need, you can go through it. I don't think that I have enough time, so therefore I'm not going to cover it today. But anyway, you know, government contribution has been changed from July 1st this year. That means just before 2 months, that was changed. If you contribute $1,042.86 for your KiwiSaver contribution in a year, government gave you 521. If you check your KiwiSaver fund now, you should have received 521 for the last year. That is the last time you get 521. From next year onwards, you will get only $260.72. That means that contribution from the government has cut down by 50%. That means from 50 to 25%. And also they inform that if you have more than $180,000 income for a year, you don't get this government contribution, even 260. That's another thing. And also the happy point from 1st April 2026, KiwiSaver contribution will go up. Currently, you know, it is 3%, and that will go up to 3.5%. And also from 2028, that will be further increased to 4%. So it's kind of happy point. You can keep hope to have kind of more money in your KiwiSaver after 2026 next year. They're kind of small changes. I don't want to go behind this because I don't see that I have enough time to discuss everything. Anyway, you can go through them later if you need. The second point, I told a couple of examples from this list. I don't know whether you can remember everything, but just take randomly few. Next thing is about excluded income. What is excluded income? Excluded means, of course, excluded. You are not considering it into your gross income. Excluded income is not part of gross income at all and is ignored when calculating taxable income. Actually, these amounts are outside the income tax network or the net of IRD, but they catch it in different other networks sometimes. For an example, we discussed earlier as well about FBT, fringe benefit tax. If any employer providing non-cash benefits to employees, we call it FBT, fringe benefit tax, should be paid by employer. Should be paid by employer. So therefore, it is not part of income tax network. Sometimes if you get GST refund, if you get a GST refund, is it an income? What is the reason to say it is not an income? There is no reason. If you can remember the definition of income earlier, it is relating to your day-to-day transactions, of course. If you get a GST refund, okay, refund from IRD. And also it is something relating to frequently happening, maybe 6 monthly, 2 monthly, something like that. That depends on your GST submission. If you get a refund, it is like connected to the business activities, but still it is not an income because it is defined as kind of excluded income. That's the reason. So therefore, in different sections, I have given some examples on the list you can see here. Different items are excluded from the income. So therefore, you don't want to pay income tax on them. But remember, when you deduct expenses, let's say a simple example, I said GST refund is excluded. That means when you consider your income, if there's any GST refund, you don't want to take it as income. You don't want to take it as income. But if you have any expenses you incurred to get the refund, let's say you need to process the refund, you went for a professional accountant, you pay some money for your professional accountant to process the GST refund with IRD. See now, refund is not an income. Refund is not an income. But that processing charges, amount you paid for your professional accountant can be taken as an expenditure. That's why I said earlier, if there are any expenditures relating to the, I don't say always, but mostly, if there are expenditures relating to excluded income, even though you don't take it as income, you can deduct it as expense. But if you see something as exempt income, we don't take into this side, like excluded income, but you are not allowed to deduct expenses as well relating to the same. So that is kind of sometimes confusing, but that's a rule. Okay. Still, I didn't get that case. That will come. I don't want to discuss this point that much because you are very familiar about accrual basis, cash basis, because you all are accountants and mostly accountants and people who are having a background related to accounting or business. So therefore, I'm 100% sure you all know what is accrual basis and cash basis rule. I'm not going to talk about that. Only thing, when you think, when do you need to recognize income? That depends on whether you are following accrual basis or cash basis. That depends. That depends whether you are following accrual basis of tax or cash basis of tax. I'm talking in tax. Okay. So therefore, the general principle, you can select whether you are going with accrual basis or cash basis, no problem. But what IRA says, the general rule behind selection of accrual or cash is depends on the way a person must, we can say, on the way that best disclose a person's actual income. That means the general principle is that a person must adopt a method of tax accounting that best disclose the person's true income. That's what we call actually correct words. The best disclose the person's true income. You need to decide which method will disclose my actual true or genuine income. Is it accrual basis, cash basis? You can adopt accordingly and keep consistency. So there is no definition for derive. When do you derive derivation of income? So roughly we understand the word as obtain, got, or acquired. They are the words coming from law. Sometime in Dixon's case, I think I have given a reference. Yeah, Dixon here. Dixon's case, generally it says income is defined as something come home. So it's interesting. That means something come home in a realized or realizable form. That is a point where you need to recognize income. Therefore, appropriate accounting method will depend on the best way that you can disclose your true or actual income. There are some guidelines provided on it. So sometime I told you some people go with accrual basis or cash basis, but IRD provides some guidelines. You can use accrual basis. You can use accrual basis as tax kind of tax accounting method. If you generate sales from trading stock, and if your accounting practice always going with the accrual basis approach, and if your business is incorporated as a company. But remember, this point is not essential always. Even though you register as a company, sometimes you are allowed to run on cash basis. That depends actually. Mostly cash basis can be used. That's how IRD guide you. If you don't have, if your business is small scale, if your business is small, you can go for cash basis. And sometimes your income is mainly based on professional skills or personal work, you are allowed to go for cash basis. If your expenditure is very small compared to your income, so you can go for cash basis. If there are no employees, you can go for cash basis. You know, in New Zealand, more than nearly 73% of businesses, do you know that point? In New Zealand, more than, as I remember, 73 point something, more than 73% of businesses do not have employees. Do you know that? That means only the owner. See the difficulty of finding a job. You know, in New Zealand, only, as I remember, less than 1% of businesses do have more than 50 employees in New Zealand. More than 98% of businesses in New Zealand do have more than 98% of businesses in New Zealand do have less than 20 employees in New Zealand. So, interesting facts. You need to think about the market. Anyway, it's a different story. But anyway, you understand, if it is a company, I told you it is not always compulsory to go for accrual basis unless you are dealing with trading stock, or maybe sometime if you are practicing accrual basis. Mostly companies even can go for cash basis if these conditions are there. So that's the way you need to decide whether it is cash basis or accrual basis. Okay, I'll go to the next slide quickly. Okay, there are some other sources of income. I don't want to talk that much, so you can go through it later. These are very straightforward. Interest, dividend, you know how to recognize revenue, because I don't want to spend more time on accrual basis and cash basis, because most people do know, they know that. There's a kind of question. Still, I have one question pending. I'll answer for that later. Do Christmas gifts given to employees come under FBT? That's different story actually. Generally, if Christmas gifts are given, they are not going through the FBT. Then again, we need to ask whether it is convertible into cash or not. In FBT, if you get a chance, one day we can discuss. There is limit for individual values. There's a limit for a quarter. Based on that, you need to decide whether the gift is coming under FBT or not. So that's kind of different story. We will get kind of discussion. Since I don't have that much of time, I'm not going to jump into that. But in FBT, we need to discuss it separately. Right, my one before the last section is to talk about several. Now, I discuss some basic principles behind income. Then I talk about what is called the second section, accrual basis, cash basis. Then before that, we discuss about exempt and excluded income. Now, one before the last section is some examples from different other sources of income. Main one I selected was employment income, because you know this is very practical, because everybody do have employment income. Therefore, I know this will be important for you. But of course, this is straightforward. You know, if you have an employment income, it is an income. You can't hide it. You need to pay tax on it. No problem with at all. But there are some key things behind it. So, you know, if you work as an employee, you get salaries, wages, allowances, bonus, commissions, gratuity, overtime, blah, blah, all these, holiday pay, leave, everything coming under your, yes, of course, they are under income. Sometime fringe benefits. Earlier, we had a kind of small discussion. FBT, non-cash benefits provided by the employer, like car, accommodation, low interest loan, etc. They are not covered under this employment income because tax is paid by employer. Remember, I told you earlier as well, if anything does not come under FBT, employee has to pay tax. For an example, earlier we had a kind of discussion related to the same. And I said I'll discuss later. For non-cash benefits, there are some non-cash benefits, but they are not going under the FBT regime. Therefore, employee should consider whether it is income to them. Good example, work-related allowances like meal allowance, car allowance, not reimbursed, taxable as a part of gross income under payee, included in employee's income. Okay, so it's like a salary that will be taxed. And also another example, like it's very hard to find examples. Employer provided share options. Employer provided share options, taxable again when required, when acquired or vested, tax should be paid by employee on such share scheme rules. Another example is reimbursements of personal expenses. Reimbursement of personal expenses by employer, that is taxable if it is not purely work related. Only work related reimbursements are non-taxable, otherwise that will be taxable. They are kind of small examples you can remember. If it is not counted under FBD, that will be taxed on employee's hand. And also when you talk about employment income, let's a simple example like this. If you use your personal car to work, to go to work and to come back from work to home, can you deduct some expenses? I'll come to the question, give me a second. If you use your motor car to go to work and to come back home, can you deduct some expenditures if you have employment income? Actually, if you have only employment income, most of the expenses are not allowed to deduct. Okay, if you have only employment income, you are not allowed to deduct any, I can say any expense. There are a couple of expenses you can deduct, especially if you pay some money for your professional accountants to your tax work done or GST work done, you can deduct that expense. And sometimes if you have income protection insurance scheme, that payment you can deduct as kind of expenditure, even though you have only employment expenditure. We call it actually employment limitation, or we call it personal limitation. So we will learn it in section D, or deductions, once we discuss it later. And sometime there are some other examples like interest you have paid to IRD for late payment of tax, you can deduct from your employment income. Other than that, you are not allowed to deduct employment income. But let's say example like this. If you work as a contractor, what will happen? I am sure some of you work as contractors. Okay, before moving to this, I'll take this question quickly. See, if the employer is reimbursing the membership fee, for an example, CA, is it taxable? That means, is it a taxable, what is called taxable income? Reimbursement, is it work related or personal? Personal, which is reimbursed. CA membership fee, if it is defined, let's say you need to have CA qualification as part of the job requirement, then it is work related. You can argue that it is work related. If it is personal, of course, I said it somewhere in previous. If it is personal, of course, you need to pay tax. You see the point? I didn't say, but I said it as an example here somewhere. Reimbursement of personal expenses. Reimbursement for personal expenses, that should be taxable, right? If it is work related, if you can argue that CA thing is work related, actually that is not taxable on your hand. Otherwise, that should be taxable. Okay. Hope you got the question answer for that. That's a good point actually. It is very practical. And next point is I was talking about employee. If you work as a contractor, what will happen? I am sure some of you work as contractors here. And also there's another question on the text. If you do online trading like forex trading as a hobby, now it's very difficult to decide whether it is a hobby or a business. Where is my discussion somewhere? Hobby and income, that should be somewhere. Yes. That should be somewhere. Yes. Give me maybe another 10 minutes. After that, we will go for hobby discussion. Okay. I have it. I thought it's missing somewhere. No, it's there. Right? I couldn't find it. Anyway, I'll talk about this hobby. There are two questions related to the same. I'll answer for them. Okay. Give me some time. I was here. Is it? Where was I? I can't remember. Where did I? Here. I talk about employment income. Did I? Yeah, I was here, I think. Yeah. I was talking about if you work as a contractor, or sometimes we call it self-employed people. We call it scheduler payment, contractor income. What's the impact? This is very interesting point. In New Zealand, it's very famous actually now. This discussion is very famous in New Zealand. You know the reason, right? So basically, if you are an employee, you need to pay, you don't want to pay your own tax. Mostly pay will be deducted, and ACC levies, student loan repayment, KiwiSaver contributions, everything will be deducted from your salary, and you are not allowed to deduct any expenditures against your employment. I can't say any, but most of the expenses are not allowed to deduct. To work as an independent contractor, what happens? Oh, we consider them as self-employed people. You need to pay your own tax, but you can claim expenses related to the, or you can claim expenses or deductions against the income you generate from your contracts. And also you need to file IR3, that means your tax return. And sometimes you can file IR10 as well, that is your income statement, sorry, financial statements, including, and also you sometimes if you pay more than $5,000 in 1 year, from the next year you need to pay provisional tax as well. Also, if you're a contractor and if you're earning more than $60,000 per year, you need to pay GST as well. So therefore, you can see what are the conditions. Oh, what's happened? My pen. Just give me a second. I'll take my pen. Okay. Yeah, sometimes there are some items, some important points for employees as well as some important points for contractors. Okay. Why this discussion is important in New Zealand? Hope you know that one. In New Zealand, what happens? I'll run through it quickly because I have another 20 minutes to finish this. Because it started nearly 7:15. So yeah, I have nearly around 25 minutes. I think can manage. In New Zealand, what happens? There's kind of very famous landmark story involving 4 Uber drivers from Wellington. That happens in 2022. You know that one. This was a very interesting story in New Zealand, and we will. I'm sure we will not be able to get any other place to discuss this story, this employee versus contractor story. So therefore, I thought to plug it here very briefly. How do you decide a person is a contractor or an employee? As accountants or professionals, my advice, you need to be very, 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 very serious, extremely serious to recruit people as employees or contractors. Otherwise, you will be in trouble. Even when you work, double check whether actually you are an employee or a contractor. Use this test to assess yourself. Also, when you recruit a person, based on these 5 tests, and there are some other thing called gateway test now in New Zealand after 2025. Based on this, you need to assess whether my people who are working for me are actually employees or contractors. You need to be extremely careful defining a person that you work for your business as employee or contractor. Because there are serious consequences. Okay, I don't have time to discuss all, but generally, if you need to decide a person as a contractor or employee, there are main 5 theoretical law point of view tests. We call them control test, independence, intention, integration, and fundamental test. What happens here? If a business control how, when, and where work is done, that worker is more likely an employee. That means high level of control, employee. Independence test. That means a worker who uses their own tools, hires staff, and takes kind of financial risk is likely to be a contractor. That means high level of independence, more likely contractor. Low level of independence to work, that person will be employee. Next one is about intention test. That means the type of arrangement or agreement that what both parties intends to help shows if it is employment or contracting agreement. That means how you intend to behave in the condition or in the agreement. That depends on the intention of doing it. So that means if you clearly show kind of evidence to say that, okay, our intention is to work as a contractor, that should be contractor. Then another one is integration test. If the worker is part and parcel of the business, if the worker is integrated into the business rather than just providing outside service or standalone service, they are more likely an employee. That means when the person is fully plugged with the business, more likely the person will be an employee. And the last one, fundamental business or economic reality test. It means if the worker is operating in a business on their own account, which profit potential and multiple clients are allowed, more likely that person will be contractor. Otherwise, the person will be an employee. So these are the five fundamental tests we had. I don't know for how many years. As far as I know New Zealand tax for last around 7 years. For the history that is there. But in October 2022, what happened? It is world famous case in world famous case given from New Zealand now. In October 2022, what happened? 4 Uber drivers went to court asking demands for employment rights and argued that they are not the contractors, they are employees. In Uber, drivers are working as contractors in general. Then what happens in employment court? They decided that yes, of course, these drivers should be considered as employees, not contractors. See, it started in 2022. Still, it's going. In mid 2023, what happened? Uber subsequently appealed to the Court of Appeal, but again, Court of Appeal said no. Still, they are employees. They are not. That means they rejected the decision. Still, they are employees, not contractors. Then Court of Appeal explain it further. Drivers are considered as employees when they log into the app. In late 2024, what happened? Uber again went to Supreme Court. Now it is in the Supreme Court actually. What happened in 2025, last month, July, as I remember, July 12th or somewhere there, in the mid of the year, July. What happened? Uber appealed again to the Supreme Court, and Supreme Court, again, it is in the Supreme Court, now it's under hearing. But meanwhile, government proposed Employment Relation Amendment Bill. In July 2025, Parliament passed the first reading of Employment Relations Amendment Bill. And this legislation introduced a new thing called, it's new thing in New Zealand, called gateway test in addition to these 5 tests. So still it is not fully finalized, but in gateway test, they are mainly focusing about another 4 things. What are those 4 things? The arrangement. That means what is the agreement? The arrangement is recorded in writing as independent contractor or employee. The condition of the employee or contractor will depend on that. That is what we call written agreement. If what written agreement says, that will be. Second point, the worker is free to perform work for other clients. If the worker is free to perform for other client, except during the time they are working for the principal, they will be independent contractors. So that means that's what we call flexibility of work engagement. No mandatory work hours means sometimes the worker is not required to work at a specific time or minimum number of hours. That means that freedom, independence is provided by employer to employee. More likely the person will be contractor. The last one, acceptance of task. That means principal or the employer do not have any power to cancel the contract if my contractors are not accepting my offers. That means there is no acceptance rate or something like that in Uber app. In the future maybe like that, but if there are no acceptance rate conditions, more likely the person will become a contractor. So there are the 4 things under gateway test. The employment relation, what is called Employment Relation Amendment Bill, we consider in the future. Okay, so this is new, but still this will be changing in the future. But still it is in the proposal and the finalizing stage. Maybe sometime this will be fine-tuned further and you can see it in the future. So therefore, the discussion of employee and contractor is really interesting and important. Okay. Another one, income from business. Here we will talk about that 2 questions I saw on the chat. You need to understand what is a business now. Anyway, of course, you can understand what is a business. In tax, Business means any activity done to make profit. Any activity that you make, you conduct to earn profit, we call it business. This is very important because you need to clarify what is, if you recognize something as a business, you are allowed to deduct expenses. You can claim some deductions. Court basically look at only two things when you define a business. What are the two things? One is that the activity is like a trade, profession, not just a hobby. They consider whether the activities are like trade or profession, not just like a hobby. If it is a hobby, it is not kind of business. Then you don't want to pay tax. Also, you are not allowed to deduct expenses, of course. Second thing, did the person actually intend to make money? Do you have any intention to make profits? Again, intention comes here. If these two things are there, more likely you are doing a business. Look at this case. I'll put the poll quickly. You can see on the screen as well. With this, I'll be able to answer for your previous two questions as well. I'll go for the poll. Oops, my poll doesn't work. Just a second. Okay, I'll go back to the polls. Where is my poll? Yeah, look at this. We'll answer it quickly without taking much time. Okay. I'll give only 1 minute because we don't have time. Yes, they're doing a business. Okay, I see a lot of people say they're doing business. Reasonable prospect of making profit. There are two answers. Yes, because their activities are carried out with the intention of making profit. Yes, but only because they had reasonable prospect of making profit. I think answer should be the first one. I see people are responding very fast now. That's good. Yeah, excellent. That's good kind of response rate. I see nobody selected no, which is good. So yeah, that should be yes actually. Just because the activities were carried out with the intention of making profit. So that should be the answer. In this case, what happens? I'll end the poll and we will go for the next. What happens here? Actually, in this case, this is a case, right? You understood the case now, right? In the previous case that I used to make the poll in the previous slide, you know, a husband and wife partnership purchase farming kind of property with 216 something acres, and they develop it to and organize it to kind of work doing kind of fencing and all others. And they had a small farm. They had a loss for a couple of years. Then what court said? High Court said, yes, they have kind of real prospect of making profit. So even though they are earning loss as a result, but still they are kind of business. Therefore, they are allowed to deduct expenses and they can claim this loss against other sources of income. Actually, original case asked what they did. Actually, they shared, they wanted to claim these expenses against other profits. That was allowed actually. Okay, so therefore, I think you can read it later. What is most important for us? When you talk about this, there are, in this same case, actually appeal court provided a lot of guidance relating to determining whether a person is carrying on a business. You need to look at several factors: size and the continuity of activities, sometimes whether you do it in an organized way, whether the person's intention, nature of the activities, time period you conduct these activities, scale of operations, volume of transactions, commitment of time and the effort you put, and pattern of activities, whether you maintain proper accounts. They are the things we need to consider when you look at whether there is a business. Okay, so that is last point. See, now relating to the same, we need to understand now whether there is a business, whether there is a hobby. See, this poll, I'll go for the last poll. This is the last one we do. A lot of people ask question on this, so therefore I'm interested to put this on. See, this one. This is the last poll we do. We'll do it quickly. Oh, no. Anyway, I made a mistake. This is not the poll I wanted. Anyway, that's fine. You go for this. Is it a hobby or a business? See, some people say it goes like 50-50. 45%, now it's 44, okay. 47%, 53%. See, some people say it's a hobby, some people say it's a business. See, very difficult to judge. As a lot of people responded, still 58% now 60% and 40%. 60% say not deductible because it's a hobby. Nearly 40% people say it is a business, therefore deductible. Interesting. Actually, when you decide this, you need to look at these factors. What is again intention? Intention. It does not, it's like he does not currently follow in any industry practice or something like that. Plans to sell a car to fund holiday. It's not kind of making profit. He need to cover some expenses. So therefore, intention is not very clear to see whether it is making profit or not. Scale of operations, no staff, no regular suppliers, something like that, no purchases parts and equipments only when it is needed. So therefore, scale of operation is very small. Volume of transactions, only 2 cars for 5 years. 2 cars for 5 years. Volume of transaction is less. Commitment of time, very limited. He spent only few hours on weekends. Financial results, it is not very big amount of profits earned. And it is not kind of, there are no significant regulations involved into this story. So therefore, it seems like this person is, see, in most of the people here, nearly 62% people said it is a hobby. Yes, correct. Nearly 38% people said it is a business. No, it's not a business actually. In this case, intention. Now, main thing behind his intention, it's not making profit. Always he wanted to cover his holiday thing, and for 5 years he did only 2. So therefore, it is very clear. There are kind of argument, but original story when they decided that it is not a business. I want to have another interesting story somewhere. Where is that? This one. Look, actually, I forgot to tell you. This is another interesting story. There was a person, he is going for deer hunting. There is a person who is going for deer hunting approximately 20 hours per year. Not even. Actually, approximately, as I remember, 20 weeks per year. 20 weekends. Yeah, 20 weekends per year. So then to help to meet the cost of his hunting activities, the taxpayer decided to sell the carcasses trucks. That means the dead bodies, dead deers. The taxpayer also purchased a Land Rover for his hunting activities. Is it a hobby or a business? Actually, in this case, again, In this case, the court decided to consider all these facts. Accordingly, court decided, no, it is not kind of business. Even he earned some money and he bought a Land Rover to buy to facilitate his hunting activities. He spent only 20 weekends for a year. It's not substantial out of 52 weekends. When he has spare time, he did it. So therefore, it's kind of hobby, even though he earned money. Understand? He doesn't want to pay tax. Another example. See now, there are two questions related to the same. I said I'll answer later. If we do online trading like forex trading as a hobby, you can't say you do it as a hobby. To decide whether you do it as a hobby, you need to look at these conditions. What is your intention? Is it to earn profit? The scale of operation, how many times you do? Is it more frequent or less frequent? Repetition or regularity, you do every day, every same fashion of transactions. You do it in organized way, or do you have kind of structural way of doing it? Do you get kind of financial results? If at least few years, your forex trading transactions is taxable. You can't define you do it as a hobby without looking at these conditions. Based on these conditions, you need to decide whether at least if you get a couple of years for these bullets, your answer will be yes, you need to pay tax. Otherwise, no. Sorry. And also, there was another question earlier. I avoided it and I said I'll answer for that later. Yeah, see, if a person performs occasional work for a company or individual, such as repairing motor vehicles or fixing computers on casual basis, see, example, once a month. Do the payment received once a month, means you do 12 times. You have kind of pattern of doing it. That's how I feel, okay? You get kind of income, you have intention to make profit, you are not doing, you are not providing your service at cost, or you are not doing that service as kind of charitable purpose. It seems like your intention is to earn some profits. You do it kind of repetitive way. You said it is once a month. And also it is kind of organized method, because you said in this example, repairing motor vehicle or fixing computers, work for a company or individuals. You are going for companies or individuals, searching people. They are not coming to you. More likely you are searching people and going. That means intention is clear. I'm 100% sure in this case, Nalaka's question, you need to pay tax on it. So that's very straightforward. It is not a hobby. It is a business. You can't define it as a hobby. Okay, I hope makes sense. Right, last couple of minutes, I'm going to spend only on small thing. Actually, it seems like I don't have enough time to finish this, because I have already spent nearly actually 2 hours as agreed. Now it's anyway 9 past, so therefore it doesn't make any sense to discuss all these. Last point, I will not go for the next one. It is interesting to think, I asked some questions earlier. If you sell your personal computer, if you sell your personal car, whether it is taxable. So actually, yes, when you think about that, you need to think about 3 things. We call them personal properties. You sell any personal properties, like if you sell your house furniture, tables, chairs, sofas, etc. Motor cars, bicycle, electronic computers, iPhones, or whatever the phones, TVs, jewelries, watch, clothes. Some people sell their clothes, putting in marketplace, used ones. We call them personal properties. If you sell personal properties, you have to pay tax. You have to pay tax in 3 scenarios. Remember, if you work in profit-making undertakings, that means if you work them as kind of profit-making things, you must pay tax. If you purchase them with the intention of reselling, you must pay tax. And also, if you work as an agent of doing it, you must pay tax. So therefore, if you sell your personal properties, if you have any intention to earn profit at the time of purchasing, you must pay tax. If you get any profit, you must pay tax. And also, if your business is working as kind of dealers of buying and selling these kind of personal properties, you must pay tax. These are 3 things you need to remember. But I feel like other things I don't have. Yeah, these are the things I explained already. Finally, I'm not going to talk about residential property rule, but I have made some notes on it. And I hope you will be able to read and understand. If we get another seminar later, since I don't have time, I thought actually I will not be able to discuss this section. Especially, I'm going to talk about bright line property rule, which recently changed. You know, in brief, you can understand if you buy and sell a property within, especially residential properties, within 2 years of its purchase, you need to pay tax. But anyway, I'll discuss this one when you get another seminar one day relating to the residential properties. So if you get another seminar one day, so we'll be able to discuss this. But this is the last section. This example, anyway, I didn't plan to discuss. So with that, since I spent exactly 2 hours, I'm going to wind up the session with this. If you have any other questions, you can post into the chat. I think I answered all the questions you posted here in the chat. Otherwise, that's it. Thank you very much for your participation today. Meanwhile, if you have any questions, you can post into the chat, okay? Since we have spent exactly 2 hours now. At the same time, I will answer one question on the chat. We provide some service to Sri Lankan online and the income is received in our Sri Lankan bank account. Are they taxed? If you are under transitional residency period, no, you are not. Your income is not taxed. Otherwise, yes. Very simple. If you are, that means if you are a tax resident within first 4 years, you have to pay tax. Otherwise, no. That's the answer very simply for series question in the chat. Right. Once again, thank you very much for your participation today, and we explored the basics of income and related areas. And I hope the session has provided you with some kind of practical insights to think about income. This is kind of very theoretical lesson, but anyway, I try to give kind of examples as well. And as you know, taxation is very wide. We cannot cover within a couple of hours. It should come with some more seminars. We will do it later in the future if you get a time. And if you need any questions, or if you like to have kind of chat with your problems, tax matters, please feel free to reach out using the contact numbers given, or even through the emails in this slide. And also a special thank for the organizers. And I hope they will organize some other knowledge sharing sessions in the future as well.